Good morning. Welcome to Trading Hour. I am Reema Tendulkar. With me are Pavitra Parekh and Surbhi Upadhyay. Girls, it's another green session, right? Quiet, but at least it's climbing higher and higher, one step at a time, up for the 8th day in a row now. And the Nifty today is above the 17,750 mark, a gain of 34 points, with the Sensex higher by nearly 75 points. In percentage terms, we are looking at about a 0.1% gain. It's a big day in terms of news flow, and ahead of that, markets are in a bit of a wait-and-watch approach. We've got results from TCS, you've got macro data, IIP, as well as CPI out in the US. You've got the US CPI inflation print, the FOMC minutes. So all that is going to take center stage post-market hours, and ahead of that, it's a bit of a wait-and-watch quiet session. The mid-caps and small caps, though, continue to power ahead. So look at the intraday chart of the mid-cap or the small-cap index, and you would see a gain of 0.5%, and these indices are at the high point of the day. So that's where the action is today, and the advanced decline ratio is looking pretty good so far at 11 o'clock this Wednesday morning. 1,900 stocks in the green for about less than 1,000, currently losing in trade. Hi.
Hi, Reema. Yes, you said it. I think just treading water, waiting for a lot of these key triggers and events to kind of pass and get some direction in. I was looking at the US CPI projections as well as in the expectations for March. So the expectation is that it will slow down a little bit from about 0.4% to just about 0.2%, and that would perhaps give markets a little bit of comfort that the Fed is not going to be as hawkish going forward.
So in terms of actual numbers, in January, US CPI was 6.4%.
Yeah.
In February, it came down to 6%. And in the month of March, Bloomberg's estimate is 5.1%. There are a few other economists at 5.3, 5.6, but slice it whichever way you want, it's still a declining trend, right? March is going to be lower than February.
So it's that. And then, of course, there are the big earnings. I mean, there's JP Morgan reporting, Wells Fargo reporting, quite a few of the other major financials are reporting. So it's going to be a pretty heavy week, particularly on Friday when we will, of course, be shut for trade. So I think markets are just taking a lot of this on board. And along with this, it's important to keep the technicals in mind, because all these events are happening just as the market has entered that congestion zone, and we pointed that out earlier as well. So the zone remains the same. You're talking about 17,760 or so, all the way up till 17,800 at the index level. So till this is taken out decisively, this has been acting as a bit of a resistance for the market, and this is the point from where the market turned a month ago. So let's watch for this. In terms of, let's pull up the contribution chart, because the day is quite interesting. You've got a lot of movers on the upside. Trends are a little hard to come by. It's not a very clear sectoral day, barring pharma. So you have some banks. I mean, that chart will tell you the story. There's a HDFC Bank, ICICI there. Infosys is rebounding from yesterday's sharp declines that we saw. But then you've got, some of the FMCG names like HUL, ITC on the downside. So Pavitra, safe to say at least the large caps, I think barring the pharma trend, the rest of it is a little all over the place, but within a green band, as Reema said.
Oh, absolutely. And that's enough for now, right? Ahead of these big cues. We'll see how tomorrow goes, of course, once we do have all of that. So like you were pointing out, extremely flat on the surface, but underneath that, there's so much action going on. You've mentioned the pharma pack, so let me move on and take a look at some of the sugar names, for instance. Those ones seeing big moves come through because the prices are higher. We have been talking about this, so take a look at Sri Renuka, Simbhaoli. These are just some of the names that are seeing good moves coming through. You have a lot of the updates coming through, a lot of the Q4 earnings. The Delta Corp is one of the first few earnings that has come out, so that one is higher in trade. You have Sula, which is seeing a near 10% move right now. So there's lots for us to talk about. We're going to get to all of that. But first up, let me just run you through what we have lined up for you on the show today. The big focus on the show ahead of its fourth quarter results is, of course, TCS, a complete roundup of what we can expect from the tech giant coming up shortly. We will also get you details on analyst expectations as the Q4 earnings season kicks off. So an overall preview is coming up for you. And to take that conversation forward on the earnings as well as the market action, we will speak with Unmesh Sharma of HDFC Securities. After that, research firm Gartner has also projected global tech spend at a healthy $4.6 trillion this year. Naveen Mishra, Senior Research Director at Gartner, will be joining us to discuss more on the forecast as well as the overall tech picture. And finally, we will get you excerpts from our chat on EVs with Venu Srinivasan, Chairman Emeritus of TVS Motors. So all of this and lots more over the next 60 minutes coming up for you.
Okay, so let's get started with technology. There is a fair amount of tech coming up for you on the show. And TCS really sets the ball rolling. It kicks off the earnings season and also, of course, the IT sector earnings themselves. So Reema, take it away. Let's start from the top. I mean, you've been telling us when we did the overall sectoral preview that it's not likely to be a very hot quarter. In fact, we could be seeing flat growth, maybe even degrowth for some of the companies. Now, where does TCS stand in the earnings expectations pecking order? Is it likely to be at least, the best amongst, what could be a flattish quarter?
You said it, right? So it's expected to be a fairly muted quarter for IT companies. In fact, the growth rate could be the lowest since the COVID quarter, Q1 of FY21. That's 10 quarters prior to that. But what we're expecting this time, that amongst the large cap for IT names, TCS is likely to report the highest growth. So dollar revenue growth, 1.9%, and a constant currency revenue growth of 1%. That's on revenues. Even on margins, TCS is likely to report an improvement in margins by 50 basis points to 25%. But that said, even TCS's margins of 25% will be much lower than the post-COVID margin high of 26.85%, and it's also going to be lower than the company's aspiration band of 26 to 28%. There you have those numbers. So it's expected to be better than the others. But again, if you compare it to the kind of growth rate TCS has enjoyed in the post-COVID digital transformation boom, as well as even the margins, 26.85% was the high, the numbers are going to look a bit muted. But then again, the macros are such, right?
The macros are such, but Reema, you're saying that it is likely to be the best amongst the larger players, right? There are still concerns that the street has. Like you said, of course, it is likely to be lower than what we have seen TCS do. But what are the main concerns? Is it their sort of big exposure to the banking names? Is it the valuations are just not comfortable? What is it?
Let me give you 3 reasons. One, growth rate is slowing down. In the last 10 quarters, TCS's average growth was 3.6%. This quarter, we're expecting it to come to 1%. Right? This is about the quarter. If you look at the estimates for the next year and the year following, now this is the Kotak estimate. They're saying FY23, TCS is likely to see a 13% growth. This comes down to 7.3% next year, and then it rises to 11%. So the street is expecting that somewhere in FY24, things start improving again. But what if the uncertainty lingers on and it goes into a hard recession, US, right? Then all bets of this improvement are off the table. So concern number 1 is growth is slowing down in the current quarter and even next year. 2, exposure to BFSI, which is in the midst of a bit of a storm right now with US regional banks in Europe. BFSI exposure is 31%. And growth rates for TCS have been narrowing. And the third reason is while valuations. For TCS, valuations at 24, 25 times is more expensive than peers.
Okay. Those are the numbers, but beyond numbers, TCS also has been hitting the headlines for the other big story, right? There's a management change underway at the company. So what would you watch out for? What else is the street looking out to hear and to get to know from the company?
Well, just to simplify it, I think I'm going to give only 2 reasons. One is on the supply side, okay, attrition and headcount. Because we've been reading headlines about how the supply side is improving. If that's really the case, then margins ought to improve. There is a reason why IT margins fell last year is because companies had very high attrition. They were paying a lot of bonuses. Some companies gave a double bonus, for lateral hires. They were tripling, doubling their salaries, etc. to get people. The war for talent, right?
But that's a thing of the past now.
That's supposed to be a thing of the past. Okay, so if truly things are under control, it's got to start reflecting in margin improvement going forward. Okay, particularly on headcount, last quarter, TCS's headcount declined. It declined by 2,200 employees, and in the past decade, TCS's headcount has declined only thrice. If TCS's headcount continues to decline, one, it's also seen as a possible indicator of demand slowing down. That's the reason why they don't want too much. One reason, of course, is they have a lot of people on board. They've overhired, maybe they've got enough on the bench. But the other angle could always be demand slowing down. And secondly, it's the new CEO, right? K. Krithivasan. He's the CEO designate. He takes over officially, sometime in September. But he will be chatting with us tomorrow in the interview at 8:25 along with Rajesh and NGS. So what are his priorities right now? Because from being a BFSI head, he's going to be the head of the company. How is he planning to navigate TCS? Is there going to be a big strategic change in the company? And particularly from him, of course, we'll watch for the BFSI outlook because that's where all the attention is.
Where the action is.
Where the action is,
Okay, all right, Rima, thanks very much. I think that's a pretty comprehensive sort of prep for us as we get ready for the big TCS numbers that come out later in the evening. And you can, of course, catch the management, Rajesh Gopinathan, outgoing MD and CEO, addressing the media at 5:30 p.m. That's when the company releases their earnings. That's happening on CNBC-TV18.
All right, we will also revisit the IT space later on the show. Naveen Mishra, Senior Research Director at Gartner, will also be joining us to discuss their projections for global tech spend. So we're really going to be looking at this space in some more detail. But for now, we do need to get into a short break. When we come back, we are going to shift focus and tell you what's going on with the commodities. There's a lot of action there as well. Manisha will fill us in. Welcome back. You're still tuned into Trading Hour. Absolutely flat for our markets, just about managing to trade in the green, around 20 points higher right now. It is the mid cap and small cap, end of things, which is looking a lot better. So that is clearly outperforming. But for now, we're going to talk about the world of commodities. We have Manisha joining us. Manisha, what are you looking at today?
Pavitra, thank you. I'm looking at all commodities soft, and what a strong run-up that we are witnessing onto this one. I'll start with sugar, and we've been talking about it for some time. It's trading at 24 cents a pound, which is almost an 11-year highs for the sugar prices. And I was talking to Marex yesterday, and they expect the sugar prices to surge to 27, even 28 cents on the higher side. So a big run-up really seems to be building here. And that is because we're looking at lower exports from India, lower production from Sudan, and also other countries like Europe. And Brazil also seems to be shifting more towards ethanol. And Thailand and Brazil, both of these major producers and exporters, also are increasing their sugar export prices. So everywhere that you look, there is support coming in from prices. But not just sugar, the Arabica coffee prices are trading at a 1-month highs. We have seen ICE inventories decline to nearly 3.5-month lows. In the global markets as well, the demand is anticipated to increase by 1.7% this year. So coffee prices also on a high. And it doesn't stop there. In the international markets, we have seen the orange juice futures hit an all-time highs as well. There has been crop damage, and there's a lot of speculative activity right now happening onto this one as well. So very strong gains onto this one. The other one that you should watch out for is the cocoa prices trading at a 28-month highs right now. Here as well, when you look at the ICE inventories, those are at 11-month lows, and the port inventories in European Union also are at a multi-month lows. So many of these agriculture commodities are trading in the positive right now. I also want to bring in a chart which tells you on how the prices have moved on a week-on-week and a month-on-month basis. So as you can see, we've seen a 9% of a jump up in coffee and sugar prices in this week itself, while cocoa is up by 3%. On a month-on-month basis, we are looking at 4 to 17% of a jump as well coming in for many of these commodities.
Manisha, should we be worried about inflation then?
Beverage bills are going up, girls. That's not good news, Manisha.
All right. Thank you very much for joining in. Let's get into a break. On the other side, we'll talk market technicals. Mitesh Thakkar joins in.
Welcome back. The market's absolutely flat, 17,750 and no more, but at least it's holding on to this 25-30 point sort of an up move. That's the story from the bulls' perspective. Well, let's straight away get to Mitesh Thakkar. He's joining in with a couple of trading ideas and a basic outlook on the market. Mitesh, good morning. Good to be speaking with you on the show. So tell us, I mean, it's very range bound in an extremely tight band, but is the trading bias still on the upside?
Good morning. My sense is that yes, I think the overall bias is definitely on the upside. Though I think, we have been advising since yesterday to take profits or at least part profits on the Nifty positions. Two reasons. One, because of the rally which we have had, and that's led the intraday indicators into overbought levels. Also is the fact that we had peaked out, around these levels of 17, 780, 800 in the month of March. The pullback rally had ended there. So there's some supply pivot. There's also a historical gap over there. So broadly, I think, while the directional bias is on the upside, I think pruning down index positions at least by half and then waiting for about 100, 120 point kind of a cut, which could happen over the next few days, would be a good idea. But otherwise, we're trading with long bias, have all buy call on the stock side. And right now, I think I am recommending a Gas Authority of India Limited. That's breaking out of a good consolidation. So buy here with a stop at about 106, look for targets of 112. And HDFC AMC appears to have reversed from lower levels. That's a buy as well. Recommend a buy here with a stop just below levels of 1755 for targets of 1820.
Okay, that's about some stocks. What about IT? What's the positioning looking like? TCS and Infy are reversing some of yesterday's losses and are moving up now.
Rima, IT1 is an underperforming sector in the short term, though I think, they have also corrected a lot. For example, Infosys from levels of 1600 plus came down to about 1380, 1360, and then it's trying to bounce back. But that strength or the upside momentum is missing. So I think at best IT will be sideways and choppy and consolidating. And you might get some upsides, but not a very significant or a very strong upsides, especially now that, we're also into the result time. I think a big breakout till it happens. My sense is that IT for the time being is not the best sector to bet upon on the long side. That will be auto banks to a certain extent.
All right, Mitesh, thanks a lot for that. That is the call on IT as well as some individual trades right now. But let's talk about some stocks which are in focus today. Sula Vineyards is one of them. It's up almost 10%. This after we saw the company's sales jump 15% on a year-over-year basis. This is its own brand sales for Q4. So Surbhi is here with the details. Surbhi, take us through all of the numbers. People definitely seem to be drinking a lot of wine.
Sula Vineyards is surging in trade today, and that is because they've released their Q4 sales numbers, and for a seasonally weak quarter, the sales numbers are pretty strong. Their own brand sales has seen a sales growth of 15% in Q4 and a 26% growth on a year-on-year basis for FY23. Their wine tourism business has seen a growth of 18% in Q4 and 30% for FY23. With this, in FY23, they have reported the highest ever annual sales. The own brand sales is a little short of 500 crores, and the wine tourism revenue has clocked in at 45 crores. The growth in revenue is largely driven by premiumization. The elite and the premium brand sales contributed to 52% of their total sales versus 46% in the pre-pandemic times. And the company also expects the wine tourism to be 100 crores for FY24.
Okay, Surbhi got that. Thank you very much for giving us the update there. That's a stock that's literally popping away with that business update coming in 9% up on Sula. We'll take a quick break on that note. On the other side, we'll put the spotlight again on the IT sector. Naveen Mishra from Gartner joins in to talk about their latest forecast on tech spends.
Welcome back. Let's continue talking about the technology space. And this time, not just from the lens of what companies like TCS and Infy are likely to report in these quarters' numbers in terms of margins and revenues, but the big picture. This is research coming in from Gartner. And in its latest forecast, Gartner is projecting that global technology spend is still very healthy. Despite all the noise surrounding the global banking turmoil, they're saying the global tech spend will stand at $4.6 trillion this year. And this is an improvement of more than 5% compared to the last year. In fact, compared to their prior projection, IT spending is actually expected to go up, despite all the headwinds that we spoke about. Naveen Mishra, Senior Research Director at Gartner, is now joining in. Naveen, this forecast is actually quite contrary to the noise and uncertainty that we're picking up in terms of headlines. Your forecast is worldwide IT spending will stand at $4.6 trillion. In the month of January, that number was $4.5 trillion. So what you're saying is, despite the US regional banks going through a bit of a turmoil, the Credit Suisse saga, IT spending is actually going up in the last 3 months. Can you explain that for us?
Absolutely, and thanks for having me here. Two fundamental changes that we see in the marketplace now. Number one, there is a clear recognition of areas of more spend versus areas of lesser spend, and that is actually driving the net increase in the IT spend you see. The areas of lower spend are going to be more about devices, data centers, some of the other spend that are not critical to the business of an enterprise. They have been already reduced by the CIOs, and this is where we see some reduction. So let me be very clear. While yes, the IT growth is healthy for 2023, there will be areas where the spend is going to be lower than what we have seen in 21 and 22. So that's one. Secondly, there are clear areas of growth. For example, IT services, where we expect about 9+% growth. Software, where we expect about 12% growth. So these are the areas where CIOs who are actually trying to look at business outcomes, not only business solutions, but business outcomes. And in those cases, they want to improve the customer experience. They want to drive upsell. They have other business objectives. The technology which can deliver business outcome, that has become a priority despite all the turbulence that we see in this environment today. And that is why you see this second type of spend, which is more around business outcome-led spend. This is adding extra dollars that you just mentioned, in as compared to from the January revision to the April revision that we see. And now, I mean, that the CIOs are very clear in terms of how they are going to look at areas which are directly related with their business priorities and can support the business outcomes.
Okay, Naveen. So you remain optimistic. What do your insights, point towards when it comes to the banking sector? Because I think a lot of concern is around banks in the US, even in Europe for that matter, whether the ongoing credit events, whether that will lead to a bit of a delay in decision making and sort of loosening of the purse strings when it comes to IT spends.
To be clear, the banking issues and the failures that we see, that has negatively impacted the sentiment, and that may have led to exactly what you said, delayed buying, some concerns, and so on and so forth. But the specific examples that we have, especially around the failures, are more around digital natives and startups, those kind of companies. But if you look at the large enterprises, they have two things still as part of their focus. Number one, they're trying to modernize their applications. When we talk to their CIOs and their board members, they want to continue on their journey despite all of this happening. Yes, we might see some temporary challenges here and there, but that continues to be the one. Second, banks around the world continue to focus on the payment ecosystem and embracing variety of technologies into that. And that remains to be a business-led decision and goes back to my earlier point, which I said around business outcomes. So while there is some volatility, but there is no fundamental change in the way banks are going to look at IT.
All right, got that. Naveen, thanks for joining us. This is Pavitra. Just a word on the tech talent. All of last year we were talking about this mad rush for talent, the talent wars, and now it's the layoffs which are making headlines, right? So take us through what that is really looking like internally for companies as far as the tech talent really goes.
Yes, Pavitra, and that's the most complex issue that every user and enterprise is facing. There are two forces playing out in that context. One, cost optimization, layoffs, activities which are not aligned with 1 or 2 year, the near future activity. Organizations and some of the big names that you have sent, they continue to deprioritize it, and as an outcome, we are losing people and layoffs are happening. So that's one force. The second force, and I think going back to some of our earlier conversation, Pavitra and Rima, that we had in the past, is the skills which are needed to drive business outcomes. The reality is that is still a challenge. We still see issues around how to find that talent. We're still trying to create internal training programs that can actually support that. So IT service providers who can support those initiatives which are actually aligned with very immediate near-term business objectives, there is going to be a demand for this. There is a skill shortage. So I think, Pavitra, now in 2023, we need to look at both of these forces together. On one side, there is a pressure. On other side, there is a crisis in terms of the supply as well.
Okay, Naveen, finally, tell us, in terms of, I don't know whether you track all of the Indian tech companies or which ones you do, but leave us with a sense on which ones to watch out for, what category, mid-cap, large-cap, companies that are more cloud-focused, SaaS. What are the lines of business which are likely to see the highest traction, and therefore what sort of companies might be the biggest winners of this year?
As Gartner, we can talk about IT services industry at large. Clearly, with all the changes which we see in the industry, those companies who are more focused on delivering the business outcomes, such as security, risk management, cloud services, consulting specific on business, they are going to be more successful as compared to those companies who are still working on traditional delivery models, supporting legacy applications, still working on people and headcount. They are going to be the ones who will be challenged and will find it difficult to weather all this turbulence. So we really need to find those bright spots in the IT services companies who are actually aligned with these changes. And the good news is there are many of the large IT services companies, including many from India, who are actually driving this change as a part of a journey and transformation for themselves.
Naveen, we'll leave it to that. Thank you very much for joining in and throwing light on the technology environment in India and worldwide. Get into a break. On the other side, we'll discuss market fundamentals. We have officially kickstarted the earnings season. Delta Corp is out with numbers. Today, we'll react to TCS numbers post-market hours. So to get us a complete preview in terms of corporate expectations for Q4 FY23, we'll be joined by Unmesh Sharma of HDFC Securities.
Welcome back. It's Focus on Earnings Season full throttle, and we have a complete curtain raiser for you. Before we get to our guest, Pavitra is standing by with a synopsis of all the expectations that are doing the rounds on the street. Pavitra.
Oh, absolutely. This is what we've all been talking about, right? The earnings season kicks off today. So we've put together a list of what brokerages are expecting this time around. So first from CLSA, they see a good quarter this time around for Q4, but X of commodities. And for the sectors that are likely to post a strong growth, they have autos, discretionary, power, and financials led by banks, while IT and staples, they think will see reasonable growth this time around. The next one is from Kotak, where they expect net profit to rise 9% on a year-on-year basis and 8% sequentially for Q4. They also estimate EPS growth will come in at 806 rupees for FY23, and then for FY24 they expect 916 rupees. Moving on to Bank of America then, they believe that the street's earning estimates for both FY24 and then for FY25 as well could be cut in half. This is on high inflation, on rates, as well as on slowing demand. So that's a bit of a negative outlook coming in for FY24 and FY25. Then let's look at individual sectors as well. Citi has put out a detailed note on how they see the various sectors faring. So auto will see margin expanding further. This is on high volumes as well as low commodity costs. So all of that bodes well for the auto sector. For the lenders then, you also are likely to see a good quarter this time around. This is all from Citi. Advances growth is likely to be strong, and we're also likely to see NIMs improve in this quarter. Then for the cement pack, they think that the EBITDA per ton will see a sequential improvement. So once again, good quarter expected for the cement players. Then next on IT, because that is the one we have today as well, and all focus is on that. So that is also expected to see growth of 1.8 to 0.9%. This is on a sequential basis, but it is really going to be the FY24 guidance that we will all be watching very closely. So that is important on the IT pack. That is everything that we're watching in terms of guidance. Moving on next to Pharma, we could see flat growth this time around, barring some fluctuations around Revlimid, but we may see margins this time supported by moderation in US generic pricing. So that would be something that is key to watch. Then let's look at the capital goods space. Citi is focusing on commentary which will come through on capex, on orders, as well as exports. So all of that will be important to watch. While for staples, they are expecting slightly better demand in this quarter. But once again, the commentary will be really important. We have been talking about that K-shaped recovery. So we want to know what the rural picture is looking like and what is happening with price cuts. And lastly, for telecom, Citi is working with estimates of marginal growth in the ARPUs. That is something that we will watch for the space of telecoms. I'm finally going to wind down with a list that JP Morgan has put out on their candidates for upgrades as well as downgrades. So on low Q4 and FY24 estimates, JP Morgan sees Kotak Mahindra Bank, Power Grid, Torrent Power, Indian Hotels and Power Finance, PFC. All of these are good candidates for upgrades. These are just the top 5 by market size. And on the opposite, that is high expectations in Q4 as well as FY24. You have Bharti Airtel, Asian Paints, Ultratech Cement, JSW Steel and Adani Ports, which could perhaps come in for some kind of a downgrade this time.
Okay, got that. So those are some views from the street. Pavitra, thank you for that. Let's take the conversation forward. Unmesh Sharma, head of institutional equities at HDFC Securities, is now with us. So let's find out what their house call is. Unmesh, thank you for joining in. Good morning to you. So we'll talk about FY24 in a bit. And I know that you folks are a little below consensus street estimates. Let's talk Q4 first. FY23 was really a saga of earnings downgrades. Is that how the year will end, with more downgrades in Q4 of FY23 as well?
Probably not FY23, but we can, we've been, unfortunately, it's been like this since the second quarter of the year. I think that story, however, has always persisted in the Indian markets. I think if you look at the last 15 years, only 2 years, we've actually had earnings which rose through the year, not actually declined during the year. So will we see that happen in FY24? Yes. FY23, look, a lot of the operating results are out already. So the earnings estimates have adjusted for that. We are at around 7 or 8% growth for this quarter, which is not that different. So even if the number does come off, it will be like 0.5% or something like that. So FY23, I think, is in the bag. The question really remains FY24. Now, the street estimates, I have seen a range of numbers between 16 and 21%. Let's say the average is around 18%. We are at 12. Okay, so do we see that number for FY24 start to fall from this quarter? Probably not, because there are so many imponderables. People will want to see, investors will want to see what happens in the first quarter and so on and so forth. So from that perspective, we do not see a cut in this quarter maybe, but that is our base case hypothesis for the rest of the year.
Okay, and what will keep driving these earnings cuts? I mean, the narratives are all out there, sticky inflation, monsoon, El Nino, but I just want to get, the biggest risks that you see that perhaps will keep driving earnings downgrades come the first quarter.
Yeah, so look, the worst of the inflation problems seems to be a little bit behind us. So unfortunately, the driver of that downgrade may change a little bit. Last year, what we saw was agri inflation was there. There was not so much, but there was non-agri inflation there. What we are expecting now is that because of the base effect starting to quicken, which is happening for 4Q as well as for the first half, let's say, of next year, the non-agri inflation, which is the larger part of the inflation bucket for earnings, right, is not something which is concerning us so much. But, you would have seen that there are all these concerns on, on the monsoon. If that starts to play out, then we will start to see a little bit of uptick on the agri inflation. Now, that's not the major driver, however, of any downgrades. The real problem, however, comes from two fronts. One is the smaller factor, which is what happens to rural incomes given all of this. But more importantly, the demand scenario continues to remain fairly difficult to predict, because the external environment on the export-oriented sectors will be uncertain. And on top of that, there is this slight issue of inflation. So from the cost side, it may not be driving earnings down as much as probably on the rates and on the headline demand itself.
So if your earnings expectation for FY24 is at 12%, which is much lower than consensus, which stands at 15, 16, even going up to 20%, as you pointed out, and we are staring at the possibility of downgrades, do you think the market returns are capped then? So even if we do see decent numbers this time in Q4, there is no reason to go out and buy stocks right now or sectors that you like.
Okay, so slightly nuanced answer on that. Look, since last August, in fact, including what I've been saying on this channel, is that as numbers come off and the external environment continues to remain uncertain, which is the base case even today, the market's not going to give significant returns. Now, how do you make money in this market, right? So we've got negative returns on the Nifty since that time. So that's in a sense good. When the market falls below 17,000, which is what happened recently, it's nice. You can see that value starts to kind of emerge in certain sectors. Now, does that mean that you go out and buy the whole market? The answer is no. What we believe is that you should use this dislocation, and the headline market, even now 17.5, is not that compelling, but certain sectors there has been, especially in the mid-cap space, there has been quite a bit of correction. So how do you play this? Look, we believe in an uncertain environment, people will give a premium to certainty of earnings, especially where there is some valuation comfort, which brings us back to the safe spaces of the large banks, select IT names. That's broadly how we are seeing it. What we also believe is that in this kind of environment, very high value stocks, even though in the short term, because of lower inflation, the consumer names are looking okay. But we think that going forward, we are going to be underweight on the consumer even now. Okay, so and similarly on the energy, NBFCs and small banks. The other is that where we do have control. Okay, so the government's doing a great job on the economy. So as far as the economy-facing sectors are concerned, where there is not very significant issue on inflation anymore, that's the type of space that we like. So if you look at our model portfolio, you'll see some industrial real estate names in there, power, even some autos in there. And then you have the thematics, right, where none of this matters and you're looking at 3 to 5 years. So financial inclusion, city gas, there are names like that which are in there. That's how we are looking at it.
Okay, so it is time to be very selective, and you cannot just go out and buy the market at a time like this. But Unmesh, I want to pick up on the autos that you were just mentioning and ask you a little bit more in detail, because there are several ways to play this pack, right? What do you like within this? Do you look at the standard, passenger vehicle makers? Do you look at the two-wheelers? Are you looking at the EV push? How do you approach the auto pack?
No, I think, on the autos, we have an overweight position on Maruti. What we are doing is that we are not taking a very strong call on... Okay, so look, there has been two factors. One is that because the sowing has been good, so we are seeing some good traction on the tractors. But if you look at passenger vehicles, Maruti is the one where we have an overweight. There is a little bit of a relative value call given, where it sits. On top of that, what we are also seeing is that not taking a complete bet on rural. So it's like sitting somewhere in the middle. Basically, that's the one call that we have taken in the auto space.
Okay, so overweight on Maruti. Unmesh, I heard you say that along with banks, even select IT offers a safe space in the market. That's an interesting, call considering all the concern that's out there. Stocks have anyway underperformed quite a bit. Is that the reason you're looking at IT? And within that, it's a large universe, mid cap, small cap, large cap. What would you go with, considering we'll start hearing from all the companies this evening onwards? Yeah.
So look, on IT, okay, so on the model portfolio, we have an underweight of around 150 bips, if I remember correctly. So we are slightly underweight in that sense, but to a large extent, that's because of a large underweight position in one large name, which is TCS. If you look at our portfolio, we are trying to get relative value through Infi and HCL. Also, when we look at IT in our coverage, we are also including some of the tech type names like the IT and the exchanges also in there. So there are two, benchmark weights that we have on Scient and MCX. So what we are doing is that we are chasing really probability of earnings delivery more than playing the thematic IT through the space. The concerns obviously are the same as with everyone, is that we have to observe through the year whether this slowdown in the, this effort of the central banks to slow down the global economy has any impact on the demand. But at this point in time, we remain fairly constructive on these individual names, even though the overall space is a bit underweight. So what we'll do is that, look, this quarter is not going to give us too much sense on that, we believe. It's going to be mostly a flattish kind of quarter. And what will happen is that we'll start to look at demand commentary, but we expect that that will start to emerge only as we go into the first quarter of the year and not right now.
Point well made. Unmesh, thank you very much for joining in. Look forward to another conversation. Let's just take stock of one more stock right now. Divi's Laboratories. That's one of the big Nifty gainers today. What's aiding the up move? Ekta joins in with the details. Ekta.
Thanks for that. Well, there is some amount of export data which a lot of the analyst community is looking at, and that is basically what is resulting in this up move that we are seeing for Divi's Lab, because the March data is indicative of a possible recovery in terms of the ex-molnupiravir sales or export sales for Divi's. Now, the export data ex-molnupiravir for Divi's Labs in March is basically showing a recovery at $92 million versus around $70 million on a year-on-year basis. This particular data of around $92 million, in fact, is the highest that they have indicated since Jan of 2021, and is higher than the run rate of around $50 to $60 million, which we have seen in the past few months. Now, a couple of key points in terms of the feedback is that the bump up is aided likely by higher custom synthesis sales and supplies of a particular API for a heart failure drug by Novartis, which could have added around $15 to $17 million just in the month of March. Now, the March data, however, should probably be taken with a pinch of salt because it is year-end, hence it could probably be seen as a one-off. However, the large data, despite it being lumpy, could possibly also indicate a trend of a recovery for Divi's Labs when it comes to ex-molnupiravir sales. Now, the March 2023 data also has no molnupiravir sales compared to around $52 million that they had sold in March of 2022. But this $70 million that we're comparing and $92 million is ex of molnupiravir. Just want to point out that for Divi's Labs, remember, it has seen quite a correction. It is up around 13% from its 52-week low, but it's still down over 30% from its 52-week high. One of the key points that the street will be watching in terms of their Q4 numbers will be a recovery in terms of the margins, which had fallen to record lows or multi-quarter lows for Divi's Labs in the previous quarter.
All right. All right, Ekta, thanks a lot for getting us all of the details. There's just no stopping the stock right now. It's at the high point of the day, over 7% in the green as we speak. But with that, we are going to get into a break. When we come back, we'll bring you excerpts from our conversation with Venu Srinivasan, Chairman Emeritus of TVS Motors. Stay tuned for that big one.
Welcome back. It's time now to get one more corporate opinion. Chairman Emeritus of TVS Motors, Venu Srinivasan, says it's a matter of time that vehicles will be successful in India. Also tells CNBC-TV18's Abhimanyu Sharma that there is a need to encourage new technologies and the government should provide a level playing field for all companies to excel.
Initially, you have to encourage new technologies which are greener and sustainable, with subsidies. But in the long term, subsidies are not sustainable in themselves. But with changes in technology, battery chemistry, I'm sure it's a matter of time that EVs will succeed because they're environmentally friendly, they're lower carbon footprint, and they are economical. So that will happen. Technology will change and it will become affordable by itself.
So how does the growth outlook seem for FY24? What are the global headwinds you feel can impact Indian businesses, not just in India, but also globally?
The first is geopolitical. I think the tensions to the east of us, the tensions to the west of us. On top of that, we have climate change. We are seeing the hottest summer in the world, hottest spring, hottest winter. And all that put together, we would like to see how the monsoon goes this year. I think as far as India is concerned, that's a very important and critical parameter.
So with a range of FTA negotiations taking place between India and several trading groups and countries, what do you feel are the demands from your industry's side and the entire Indian industry's side from the government as far as increasing India's global footprint is concerned, as well as allowing other products into India? Because of course India does not want to be protectionist, but on the same time also wants its products, its services to be delivered across the world.
First is to give us a playing field in India where we can excel. I think a country where the environment encourages productivity, encourages product development and technology, and make the most competitive products in the world. I think if that happens, we can go and compete in other markets and allow other people to equally compete in our markets.
Now, my final question to you, as far as your industry is concerned, it has faced several challenges of late. We have seen not just as far as new energy is concerned, but even in fossil fuels, fossil fuel segment, there has been a lot of challenge, a lot of concerns which have been raised in the recent past. What are your demands from the government as far as this financial year is concerned, and your medium to long-term growth outlook is concerned, the government should do to alleviate distress in your sector?
Ultimately, we do well when the country does well. All we look to the government is to provide economic growth. And once economic growth comes, I think our industry will do as well as all other industries will.
All right, that is a very interesting chat with Venu Srinivasan of TVS Motors. We're going to wind down on the note that the market has climbed up a little bit more, around 40 points higher right now. So thanks a lot for tuning into Trading Hour. We have halftime report after this short break.